Mortgage rates were supposed to come down. Instead, they are rising. I get this question all the time. Why are rates up? Well, it's because Fed doesn't directly control rates. Okay, more indirectly. The average 30-year mortgage rate has increased to nearly 7%, which is nearly 100 basis points higher than it was back in, mid-September. Mortgage News Daily had the average mortgage rate at 6.11%. Today, it has it at a dead even 7%. So you're talking about nearly 100 basis point increase when the Fed is just cut rates 50 basis points. So a lot of people are going, where is the beef? What's going on here? Now, mortgage rates follow not the Fed funds rate. Remember, that's what the Fed, when they're raising and cutting interest rates, that's what they are impacting, the Fed funds rate. But the mortgage rate follows a different number, which is the 10-year Treasury rate. And since that announcement of cutting 50 basis points, the long end of the curve, the 10-year and beyond, that has actually been rising. Why? Because inflation expectations are rising. Economic data also has come in a bit stronger than had been expected. So the market had priced in a more aggressive Fed policy or Fed easing cycle, and that's kind of come off a bit. And those two reasons are why you're seeing rates rise, along with, you could say, a third reason, which is the supply of treasuries as well. And so you're going to get an announcement, I think it's this week, the Treasury refunding announcement of how many bonds they need to issue for the fourth quarter. Are they going to issue more short-term or long-term, et cetera? And that will be important as well, and where the 10-year Treasury goes. Now, in addition to the 10-year Treasury, you have mortgage lenders needing to cover their costs to make a profit. So they add some sort of additional rate on top of that. Mortgage lenders have been struggling as of late because of lower volume. And so a lot of times they need to up their spread to maintain their business, as well as the Fed has been trimming mortgage-backed securities from their balance sheet, which means more private lenders are having to come in and finance the mortgage market as opposed to the Fed. And they also want a bigger spread. So all of these factors mean that higher mortgage rates are relatively here to stay. What does it mean for you as a buyer? The first thing you have to know is the market is becoming more balanced, okay? And that you're not going to get back to 3 or 4%. Mortgage rates most likely in the 6 range, I think is what you should expect. 5.5 maybe you get to 5, but probably 5.5 to 6.5, maybe 7% in that range, right? 7% where we're at now is kind of the range you're probably going to see the market. You shouldn't just tie yourself to what the mortgage rate is doing. You should buy a house that you can afford. Maybe you can refinance in the future, but it's really all about finding things that check your boxes and so that you're going to want to hold for many years into the future. And that's what you have to think about. Don't just try to time the mortgage rate.